Take a listen to what I said last night. It is possible that markets do take the attack on Iran as a positive. Believe that or not, we've seen that many times before. In fact, that's exactly what happened. Israel did a limited attack against Iran for their attack on Israel, which was hundreds of ballistic missiles, but no oil production facilities or nuclear facilities were targeted, so markets took that as good news, and stocks went higher today. And oil markets were trading sharply lower, which would make sense given there was no attack on Iran's oil facilities. Oil is down 5.5% today. But this is bad news in bond markets because bond markets are continuing to be unhinged. 10-year treasury yields today are up 5.5 basis points to 4.288%. So almost 4.3% on 10-year treasuries. Stocks took this Israel news as good. Bonds didn't care at all. And you would expect that if oil was down 5.5% in a single day, that would lower inflation expectations, which would be good for 10-year treasuries. That did not happen. So that is unequivocally bad news and a bad sign. Now here in this video, I will break down all of the news and information that you need to know for the trading day today. In fact, statistically, October 28th is the best day for the stock market in any year. So it would make sense why markets are higher today. In fact, since 1950 through 2023, on average, the S&P goes up 0.51% today alone. And the S&P up 0.43% is pretty much right on par with historical averages. October 29th has a historical return of 0.32%, the following day of 0.23%, and then the day after that of 0.08%. So this move today is really just on average what you'd expect to see. But we did have some bad news for the AI sector. Nvidia is down 0.74% today. This comes after Reuters reported that Taiwan Semiconductor, better known as TSMC, had suspended shipments to China-based chip designer SoFago after a chip it made was found on a Huawei AI processor. Huawei is restricted from buying such chip technology to protect U.S. national security. TSMC could face penalties from the U.S. Department of Commerce if it willingly violated U.S. export controls in China. TSMC alerted Taiwan and U.S. authorities and began a detailed investigation after news broke that its chip had been found its way into a Huawei product, Reuters reported. Despite this, the Russell 2000 is the outperforming index, up 1.6% today, the Nasdaq up 0.5%, the S&P up 0.37%, and the Dow is up 0.7%, which the move in equities is what you would expect to see if oil fell 5.5% in a single day. That means inflation is less likely to be a problem. That is less of a burden to companies, especially companies that are vulnerable to fluctuations in energy, which are Dow and Russell 2000 components. But the move in bonds, again, is not what you would expect to see. You would expect to see an opposite of this. You would expect to see 10-year treasury yields down anywhere from 5 to 10 basis points today. In fact, they're up 5.5 basis points, which leads me to believe this move in equities following this drop in oil is probably short-term lived in nature. Again, I would feel a lot more confident to say stocks are going higher if 10-year treasury yields went lower on this news. They're not. And in fact, I think this is actually the election that is starting to get priced into markets even more today. And I think that's why 10-year treasury yields are breaking out to now a multi-month high. The last time you were this high on 10-year treasury yields was July 24th, 2024. And that makes me ask the question, if 10-year treasury yields are pricing in more of an election risk, does that get reflected in equities in the coming days? And I think it will, judging that the bond markets are pricing in the election risk, but it's still in uncertainty. Is it possible that equities just don't price in any election risk and the bond market prices in all of the election risk? That is a possibility, although I think it's unlikely. It's a possibility. As I talked about in the last video, this week is really filled with earnings, economic data, and potential election risk. And I think that's why for the next couple of weeks, we are really in an elevated risk environment where I think the odds of a correction, considering we have not seen one in a while, are higher than what they normally are. There's always risk of a correction at any given period if you're investing in markets, but there's certain periods that have higher risks, and I think we are in a higher risk environment. Albeit, most people expect we're not going to know who the next president is or who controls the Senate right after, November 5th. Most people think it's going to take a couple of days at least to figure that out, and that's where a lot of the problem could come in for equities. As long as there's liquidity in markets, you don't really want to be concerned. But if there is a delayed result of the election, liquidity could dry up and that would push stocks lower. So I don't think it's just this week that, could be problematic. It's after the election that could be problematic as well, if it's not a just blowout in one direction or the other, politically speaking. And that's actually what Sven Hendricks, someone we cite on X all of the time, just said on CNBC. As long as liquidity remains, you want to stay bullish. Via government deficits being 6 to 7% of GDP. That typically happens during recessionary periods. That is stimulative, so on and so forth. If we don't have election results right away, liquidity could dry up, and that would be a problem for markets. Also today, Apple Intelligence just launched. This is for the latest iPhone 15 and the upcoming iPhone 16. But you're really not getting many features. Many of the features that some people are looking forward to, like the ability to edit an image out of a picture, for an example, comes out in December and in spring of 2025. I have my concerns that Apple Intelligence, which is the second product ever in AI that is expected to merge AI into the mainstream population, is a bit overhyped and is going to underdeliver in the near term, but I have no idea when we're going to know that with a certainty. In fact, it wouldn't surprise me if Apple just tries to pump their stock on earnings and say Apple Intelligence is doing great. Like, honestly, that would not surprise me at this point. Apple has quite a way of tricking investors, making things seem like they're a lot better than they actually are. In fact, Apple is a no-growth company. Apple has no growth. It doesn't grow. And Apple is trading at all-time highs. Tim Cook sure has a way with words. And part of the reason why Apple is trading higher today by 1.34% at the time of recording this video is because Dan Ives, one of the best, highest ranked tech analysts, said that Apple is going to beat expectations for this quarter earnings. Now, in all fairness, Dan Ives says that every quarter about Apple, and he's very bullish on big tech into year end. So that's really not anything new. Over the next coming days, we will get more analyst commentary about upcoming big tech earnings, and that will help swing markets higher or lower heading into them. Which, as I previously reported, we have big tech earnings coming tomorrow in after hours with Alphabet. You do have Microsoft and Meta Wednesday and after hours, and then Thursday and after hours you have Amazon and Apple. So 5 companies over $1 trillion a piece in market cap will be reporting this week. I personally think expectations are high for big tech, and I'm going to be surprised if we walk away from those earnings just blown away. I think you need blow your mind kind of earnings from big tech to get another 5-10% higher from here. I think just okay earnings, not blow your mind kind of earnings, could easily give you 5 to 10% downside on any of these big tech names. And that's why I'm a little bit more concerned about big tech, at least for earnings, than I am for the rest of the markets. Other notable earnings that come out this week, today and after hours, you have Ford, Cadence, which is important for the AI trade, Waste Management, and F5, big software name there that's done very well in recent months, over the past 12 months. Tomorrow morning, SoFi, PayPal, BP, McDonald's, Pfizer, Royal Caribbean, JetBlue, and Crocs. Also Tuesday and after hours, you have AMD, Snapchat, Chipotle, Visa, First Solar, Reddit, and Chubb. Wednesday pre-market, Eli Lilly, Caterpillar, Humana, Biogen, ADP, and Jinko Solar. Wednesday and after hours, besides Microsoft and Meta, you also have Coinbase, Robinhood, Sonova, Etsy, Riot, Roku, Carvana, and Starbucks, even though they already pre-reported. Thursday pre-market, Uber, Peloton, Merck, ConocoPhillips, SiriusXM, that's one Warren Buffett's been buying a lot recently, Altria, MasterCard, Estee Lauder, Kellanova, and Norwegian Cruise Line. Thursday and after hours, Amazon, Apple again, Intel, Atlassian, and a couple of others. And then Friday pre-market, you have Fubo, Chevron, and ExxonMobil, as well as Wayfair. Let me know your thoughts down below in the comment section if you're bullish or bearish on this earnings season and what companies you are bullish on, what companies you are bearish on. And wow, Ryan Dietrich on X writes, the last time the S&P 500 fell more than 1% in November was 2008. It has been higher 11 of the past 12 years, and this has been the best month since 1950, the past decade, and in an election year. The second best month of the past 20 years, only July is better. Now, what tends to happen, what really skews these numbers, is after elections, you tend to get a rally in markets, at least historically, and just normally, you're in the holidays season, you're in the holiday period. People tend to be more bullish during this time of the year. You tend to get that early Santa Claus rally as well in November. So that's why November tends to be a standout month. And Bank of America's Savita is back with a similar prediction that Goldman Sachs just had. She says, quote, today's valuations suggest 1 to 2% price returns per year for the next decade, but 4 to 5% returns for equal weighted S&P 500. So honestly, at this point, you should be begging for a bit of a flush out in markets to reset valuations a little bit. The NASDAQ 100 index long-term moving average breadth continues to diverge from price. When you get these bearish divergences, they do tend to lead to pretty major corrections. You can also see this divergence in the S&P's RSI. There's definitely a bearish divergence in the RSI where you're hitting higher lows, right? Where you're not going as high as you previously did. Now that has been happening for a period in time over the course of, really at least since 2024, at least since July, you've been in this bearish divergence. But if you look at the weekly, there's definitely a bearish divergence here in the S&P, dating back, really to, again, early 2024, where the RSI hit a high of about 80. It fell, it went back up. It did not quite hit that 80. It only hit about 78, 79 or so. And ever since then, ever since July 2024, there's really this lack of momentum in the RSI, whereas markets continue to go higher. So markets are going higher, the RSI is not. That looks like a short-term technical problem for markets, and it looks like that will spell more downside eventually. Now, when does that downside come? When does that correction come? I think that is still a very open-ended question. In my personal opinion, I believe you get a correction here relatively soon. I made my prediction on October 21st that you would see a 10% correction within the next 6 weeks. So we'll see if that does happen. If that does happen, it means November is going to be a statistically very bad month where it normally is a good month for stocks. So it's really a call that's going against the grain of what a lot of people are expecting. And that's kind of what tends to happen in markets. You tend to get the markets that try to screw the most amount of people as possible. And if everyone believes markets are going to do great into year end, that probably means the opposite is going to happen. Now, I am expecting another correction in spring of 2025. I believe that correction most likely comes with the second round of growth concerns. That's likely going to mean payroll reports that start to miss expectations. That likely means retail sales, consumer spending that starts to miss expectations. Wouldn't surprise me if the holiday shopping season misses expectations, and that can also cause some fears in the first couple of months of 2025. So I actually think we're in for a pretty volatile next couple of months. But longer term, I have gotten more bullish on the prospects of a soft landing. It has become obvious to me inflows are going to keep on flowing. People are going to continue to plow their money into markets. I think to a certain degree, the dynamics of investing have kind of changed, hence why I don't think valuations really matter. I don't believe the Goldman Sachs or Bank of America argument that returns are going to be lower in the future based on where valuations are today, because I don't think we can look at markets historically and say, yeah, we're overvalued or we're undervalued. Just look at the rise of retail investors alone. Don't even consider 6 to 7%, deficits the government is running, which is very stimulative in nature. Those are like recessionary deficits that are happening today in a strong economy. No wonder GDP is over 3%. We're running recessionary like deficits during a time where the economy is, on paper, not in a recession. I don't think you can use the same standard quo as valuating markets, over the past 50 years as you can today. Again, the rise of retail investors that tend to be more risk on in nature. Like, we haven't went anywhere. I mean, I've been in the market since 2015, 2016, but other investors, right, that joined the markets 2020 until now, they're here. Largely speaking, they have not went anywhere. And they continue to buy. They will continue to buy. Now, Norway's $1.8 trillion wealth fund has issued a stock market warning per CNBC. It said heightened uncertainty and concerns over the economic outlook mean that the stock market risks are tilted to the downside. They say, quote, time to be a little bit cautious, they said. Now, let's be clear. This was Norwegian's wealth fund, a $1.8 trillion wealth fund. What this fund does is it invests in publicly traded companies. It can invest in private companies as well, but a large chunk of this is in public markets. And it's not in Norway's stock market. Let's be clear. It's in the United States stock market. This is not a warning for Norway's stock market. This is a warning for America's stock market, because that's where they are investing this $1.8 trillion, largely speaking. So it's not just me that says it's time to be a little bit more cautious. It's also Norway's $1.8 trillion sovereign wealth fund. Now, here on the day today, Dallas Fed Manufacturing Index did miss expectations. You were expecting -1. We came in at -3.0. So again, weakening economic data did not have the effect of pushing down 10-year Treasury yields. 10-year Treasury yields rallied in spite of that, okay? Now, if we take a look at tomorrow's economic data, we will get wholesale inventories month-over-month advanced data. We're expecting 0.2%. Last month was 0.1%, really not a big deal. Retail inventories excluding autos, expecting that to be positive 0.3%. And the goods trade balance. Advanced data for September, expecting negative 96.1 billion, worse than last month by about 2 billion. The big data we get tomorrow is JOLTS job openings. We are expecting 7.99 million job openings. Last month was 8.04 million job openings. If we see this number fall a lot, that's going to lead to concerns about the labor market. I don't think that's going to happen. I'm really not concerned about the economic data for this week, considering it's right before the election. Take that for how you will, but I'm not too concerned about it. Could it come in low? Sure, it's definitely possible. CB consumer confidence is expected at 99.3. Last month was 98.7, so expecting confidence levels to grow within CEOs. JOLTS job openings, or JOLTS job quits, are expected at 3 million, down from last month's 3.084 million. Dallas Fed services expected at negative 2.1. Last month was negative, or 2.5. Last month was negative 2.6. So we are expecting things to get a little bit better with the Dallas Fed services. You also get a 7-year bond auction. That will be something to watch, coming out at 1 p.m. Eastern Standard Time. So tomorrow is actually a pretty big day as far as economic data. Let me know your thoughts on that down below in the comment section. But with that said, that will go ahead and conclude this video. In summary, I don't think today is nearly as good as you would think. If you exclude Apple here alone, the S&P would barely be green. Now, Apple is up today. Now, that's fine. But I do think the 3 E's still have a larger risk to markets than a larger, positive to markets. Are the markets going to price in good things for the election this week? No. If we get things priced in for the election, it's going to be negative. That's a negative for markets on net. Earnings, big tech expectations are too high. I would say there's a greater chance of disappointment than a greater chance that we underestimated big tech. My thoughts, my opinions, especially following today's, 1+% move for Apple, that becomes a little bit more obvious to me and hopefully to you guys as well. The higher these stocks go into earnings, the higher the expectations are, the more likely to disappoint. And then economic data, that could be the bright spot of this week, but it's always possible we do miss. So when I add these things together, I think today is pretty standard. It's the best day of any year historically. But does that strength continue in the coming days? It's hard to come to that conclusion. So let me know what you think about this information down below in the comment section. Have a great rest of your day and a safe day, and I will see you in the next one.